Forbes Books presents Sustainable Leadership and Disruptive Growth with David Radlow. Transformation for a new and better world. Here's David.
Thanks for joining me once again for my conversation with Harrison Perry, the partner and co-founder of Fulcrum Fund. We've been talking about what inspired him to build a private equity fund focused on reducing the wealth gap and investment in underserved communities. Harrison, can you walk us through a typical week in the life of Harrison Perry?
Yes, a typical week is that we're working kind of whenever the calls come in. So that could mean that on a given day that there's some downtime where I'm hitting the gym or working out for a little bit during the day. But it could also mean that, we're working, taking a call at 8 a.m. or at 11 p.m. at night. So I think it's very variable based on, what the portfolio companies need support on and where we are on the deals that we're closing. But, typical schedule would be like a 9 to 6:30 and then picking up otherwise when I need to on the weekend or evenings if calls come up.
You noted that depending on who you're dealing with and what the situation is. So does it ever stop? Are you in control or are the deals in control?
I would say a little bit of both. Everyone should look to manage time and manage schedule. And in an investment firm, really, your own bandwidth and areas of focus and deals that you choose to focus on, that's really the piece that you can control. Is which deals do you spend your time on, which companies and that do you end up investing in, and how do you help drive the results for those businesses. So you can control the deals that you focus on and the categories of places where you spend your time, but when a deal needs to close in a certain timeline, it has to close on that timeline, and you really have to be focused on executing on that regardless of some of the other factors in your life.
How do you manage your pipeline, and discuss, if you could, what a pipeline is and how you prioritize it?
Yeah, the investment firm dynamic is that you look at a lot of deals and you invest in very few. And so a typical dynamic might be you look at 300 opportunities, you advance on 10, and you invest in 3. And so when you look at that sort of pipeline, you have to be very focused on that 10 to 20 that you really spend the most time on. And you want to make sure that when you go to advance towards closing on the 3 or 4 that you are going to close, that you have a high probability close rate on those. And so that's the main thing that dictates the success when you get into those later stage is pace and momentum. So I'm very focused on moving the deal forward, moving the investment process forward efficiently, and then also building trust and a close relationship with the executives that we're partnering with. For us, 100% of our prior investments have been in proprietary platform businesses. And so that's something we're very proud of, is building those direct relationships. And that's something that's resulted in a better close rate of converting the pipeline.
How do you manage the continuing need to bring in capital?
In the investment business, you're constantly raising money and deploying capital. So you're constantly doing both. And even though there may be cycles to that capital raising, you're really always focused around investor relations. So building the relationships over time with investors, with good reporting, with demonstrating good returns, and showing how our firm is unique and differentiated and how we add value is critical to the investor relationships. What we've looked to do is build kind of lifelong relationships with our investors. And what that enables is that you can keep expanding the investor base over time if you're delivering well for the prior investments. And what we've even seen is, even in a case where things may not go according to plan, if you communicate well and take all of the measures that are within your control to try to optimize the results, investors can still recognize that and will often still invest with you in the future, even despite one poor experience from a returns perspective, because they see that you're a good manager and a good steward of the capital.
How about operating companies with excellence, the need to operating partners to pull margin and excellence and growth out of the companies that you're involved with? How does that work?
We look to back very strong teams and identify diverse executives with exceptional talent that are leaders in the industry where we're focused in. And so we spend a lot of time building relationships with executives, networking at diverse business events, and really finding the next group of leaders to drive businesses forward to the next level of scale. And we have a very strong advisory board and operating partner team that's able to support the executives that we back with additional guidance and sage experience from their careers.
How about the use of analysts to work the front end on deals? How does that work?
Well, as we were talking about with the 300 opportunities that we look at, we have a set of criteria that we use to evaluate if an investment opportunity fits within the parameters of our investment focus. And so our associates and analysts on our team and focus on identifying whether a new opportunity fits within the criteria for our investments and whether they see strong potential for us to continue to evaluate the deal. And I think that's part of what gives a great experience for junior professionals is being able to get a lot of opportunities to look at a lot of deals and see a lot of different types of businesses and learn from those analysis and that process.
Okay, what about your relationship with iBankers and debt providers? How does that work?
With investment bankers, we're very focused on segments of interest and sectors where we're pursuing platform opportunities. So we've been very active in working with investment bankers for tuck-in acquisitions and working with investment bankers in segments that we see a tremendous growth opportunity in. And oftentimes investment bankers are specialized in certain segments. And so we're able, through the partnerships with the investment bankers, to identify businesses in those target segments. Bankers on the lending side and debt providers can be very supportive in the same dynamic, but are also helpful in terms of supporting the companies after we invest. And so we have really some great relationships with national and regional banks, and those lending groups are important business partners as well for our portfolio companies and for the business community. And so we really, in particular, look for banks that have a focus around diversity, equity, and inclusion, and banks that are supportive to minority business operations and minority business communities.
Could you give the definition of a tuck-in acquisition or add-on acquisition versus a direct acquisition if you could?
Typically, a tuck-in would be a case where we would have an existing primary business that we've invested in that's a larger company that may have 50 or 100 million of revenue, for example, and then we would look to merge a slightly smaller business in with that larger company to help grow the capabilities and market reach of the larger initial company we invested in. So the tuck-in would be that smaller follow-on merger that we complete of a company that might be 10 or 20 million of revenue merging with the larger $50 million company.
What is typical for healthy debt requiring company? 50%, 60% of a purchase price? Why do you do it this way?
It depends on the size of company and the profile of the business and cash flow dynamics of the business. But for us, with businesses that have typically 3 to 10 million of earnings, we would look at about 2 or maybe on the high end 3 times earnings as the amount of debt. And that would probably equate to about half of the purchase price, maybe 40% of the purchase price being debt. And then we would do about an equivalent level of equity into the business. And then we would reserve a significant amount of equity for follow-on investments and for growth initiatives for the business. And I think the reason why we keep it at that level, as opposed to some private equity firms that you may see using very high levels of leverage and maybe using 4 times or 5 or 6 times earnings, is that we're very focused on growth. And we're also very focused on supporting minority businesses with strong capitalized balance sheets and putting businesses in a place where they can grow rapidly and aggressively and where they aren't held back by too much debt.
Could you kindly explain what arbitrage is, buying at 4x and selling at a higher multiple, and how that benefits transactions? How could such a higher multiple occur? Is it great buying, great selling, improved growth, or all the above?
I would say all of the above. You know, the old adage of buy low, sell high, of course, applies always to the investment industry. But really, you know, there's not a magic recipe for multiple arbitrage of just buying crazy low and selling crazy high. You know, I think where the opportunity to increase the valuation on the business, increase the multiple that you receive on the amount of earnings that a company has, is if you're able to grow the company, if you're able to invest at a smart price and on smart terms in a way that's aligned with the executive team and the sellers of the business. If you have a direct and proprietary relationship with the executives, you're able to then structure very favorable terms to both ourselves as the investors and to the existing ownership group that's looking to take a second bite at the apple as the company grows. And so that's what we look to do: build a relationship with the founders and executives at a business, invest with well-aligned terms into the company. Then we look to grow organically. That can be through the momentum and relationships of the executives at the company. We also have a tremendous set of direct network at our investment firm with many Fortune 500 companies and other customers that could be applicable for our portfolio company. And so we have a history of bringing a significant amount of incremental revenue to the companies to help accelerate their growth. And then we will use tuck-in acquisitions to also invest at favorable terms and then build scale. And once we achieve scale, and once we have a very well operated and run business, then when we would eventually look to exit our investment position, the market would recognize that with a stronger valuation in terms of the multiple on earnings than what we originally invested at. And that's how you generate great returns like we have in the past.
Okay, thank you for that. Could you explain what a deal thesis is and how does it apply in certain situations?
Every time we invest, we look at what is the growth plan and what is the thesis from a qualitative perspective as well for what we think can be possible for the company. An investment thesis might be building key infrastructure for our country to help America scale its aging infrastructure system and invest in a business that's best in class at one particular vertical in that infrastructure arena and has a great team to capitalize on the opportunity. So we would look at a thesis and we would be excited about the infrastructure market opportunity. And we would then identify the team and business that have the capabilities to execute against that thesis.
Okay, we're going to focus on how you guys have done so phenomenal with your returns. Going to delve into the secret sauce. Is lots of luck or a secret sauce business model? What companies are you acquiring and how does it play in?
At Fulcrum, we have a very unique model that I do think has some tremendous elements of secret sauce to it. We focus specifically on the diverse business market and focusing on backing diverse executives and building minority businesses of scale. And what we have found is that the diverse business market and minority businesses do not have the same level of access to capital as non-minority businesses, as particularly equity capital. And at Fulcrum, we are bringing equity capital to bridge that capital gap and enable significant growth opportunities for diverse executives and minority businesses. And what we have found over the last 8 years of investing in the sector is that there are tremendous underserved subsectors that provide a great opportunity for outsized returns. And there are tremendous talented executives, many of which we have now in our network, that can help us grow and drive great returns on our investment strategy. So really, it's about that market niche that we focus on. And in terms of the value add for the secret sauce, what we look to do is build organic revenue growth first and foremost. And we start with our own relationships, with having built a deep network of contracting officers, of senior relationships at Fortune 500 businesses, where we can introduce our portfolio companies and provide unique access to very strong commercial customer opportunities. And so that is really a secret sauce. And then being smart about the executive network that we've built and bringing the executive talent to help scale a business, to fill any gaps that may exist in the leadership and organization at the business, to be able to take the company to the next level. And once we've done that, then the returns follow, and then the secret sauce happens.
You've been quite successful, and your track record perhaps speaks for itself on how you've been successful in raising money and getting funds off the ground. And could you just explain what does the funnel look like on the amount of calls, duration, and follow-up in order to get funds off the ground?
I think getting the investors is an outcome as opposed to an input, if you will. In other words, building the track record, demonstrating the investment strategy, proving it with our own money, proving it through our prior history. That's the first element that comes before raising larger capital, right? The raising larger capital is then possible because we've demonstrated a unique investment model, unique value add, and an opportunity for very strong returns. When investors can see that history and experience set and believe in us as investment professionals, then there's an opportunity to pitch for investment. And then you have to really meet with a lot of investors because each investor has separate underwriting criteria and profile of investment that the investment firm is looking for. So then there is some element of a numbers game of being in front of enough firms, getting the right meetings, getting the right introductions to be able to get to strong conversion. And we've been very fortunate at getting those meetings and a high conversion rate into follow-ons for our firm over time.
You've held management and board of director position with several companies, and I know at Fulcrum you're intentionally investing in underserved communities. But how can we get more members of those communities into management and board positions?
It's a challenge that has to be addressed in a proactive manner. What we're constantly seeking to do is identify strong executive talent of any ethnicity with an emphasis on African American, Latinx executives, and executives that have deep industry experience in the core verticals where we focus. And so we meet the executives through a number of different avenues, through peer referrals, through business networking, through accountants and other industry professionals. For example, Antoine Ford, one of our executives and operating partners that we've worked with for many years, is the vice chair of the U.S. Black Chambers of Commerce. And he sees the Black Chambers of Commerce as a tremendous organization with a lot of great talent in that organization. And we see a great path to identifying talented executives in that organization as one example. So that's some of the proactive steps that we take to find great talent and to build diverse boards and diverse leadership teams.
What's the biggest opportunity that you have that is credit to your success? And discuss the mix of hard work, teamwork, or is it just parting your hair correctly and luck?
I think really the biggest challenge and biggest success that I'm looking to accomplish lies in the next 5 to 10 years ahead for me and for our firm. We're going after addressing one of the toughest and most pivotal issues in our country right now, which is the racial wealth gap. There is a tremendous gap in the wealth levels, Caucasian relative to African American families, for example, in our country. And there is too large of a gap in the wealth levels throughout many of the communities in our country. At Fulcrum, we are looking to have a double bottom line impact in terms of strong returns, but also strong impact on closing the racial wealth gap in our country. For me, to be able to be part of something that is such a tremendous effort and pivotal to the future of our country is something that I'm very proud of, and that I think something that really drives at my core mission and speaks to my heart as to what I'd like to accomplish. And so I think we've got a hard task ahead of us of demonstrating and proving the opportunity and proving that tremendous returns can be accomplished through equity investments in diverse businesses. We've shown that over the last 8 years. We need to show it at greater scale now. And that is a tremendous opportunity for myself personally, for our firm, and for our country.
For the benefit of younger people that are coming up listening to this podcast, when it comes to business, your experience in strategy, M&A, and private equity, what are the most important skills to hone in on? Also be kind enough to shed any clarity on whether or not it's important to learn from content and context from a bad deal.
Well, I think for a young professional, you want to start with the core skills of, in the investment business, it's financial analysis. It's learning how to work on a team, learning how to engage with a variety of different team members with different skill sets and different focus areas and different personalities. And so I think for a young professional, learning how to be successful in that team environment, how to build the hard skills of financial analysis, of business analysis, and of understanding the core of what makes a company successful, and figuring out, I think, also how to identify talent and differentiate talent. And so those are some of the key pieces I would have as takeaways for young professionals.
That sounds good. Is there anything else you'd like to share that could benefit people interested in M&A and private equity, as well as anything else?
At Fulcrum, we're encouraging private equity professionals from all career backgrounds and all ethnicities to pursue the opportunity in private equity, because we think that it's a tremendous industry sector that's important to the growth of our country. And so I would just say that we encourage a variety of professionals to apply for positions and pursue careers and see private equity as a great business opportunity and life opportunity.
Harrison, could you be kind enough to just give the Fulcrum website for anybody that wants to learn more about Fulcrum and more about private equity?
Yes, it's FV as in Victor, LCRUM.com. And so note that the second letter in Fulcrum is a V and not a U. So we always have to spell things a little bit differently. And so that's something fun we did with the name at Fulcrum.
Thank you very much, Harrison. I really appreciate having you on.
Thank you, Dave. Really enjoyed it.
To connect with David, go to davidradlow.com. David's book set, The Principles of Cartel Disruption and Secret Stories of Leadership, Growth, and Innovation, are available wherever books are sold. This has been Sustainable Leadership and Disruptive Growth with David Radlow, a presentation of Forbes Books.